everyone. This is Abhijit Chatterjee recording our weekly session of Chartsarefun. This is for the week of September 15th, recording this on Sunday, September 21st. This was the week of the FOMC decision. The market was anticipating a cut. They got the cut. Turned out, didn't just get the cut. Fed indicated potentially 2 additional cuts for the rest of this year and another cut in 2026. Initially, there was a knee-jerk pullback, and then the market kind of took off after that. So we had discussed a potential melt-up situation. So we'll look at least in the near term, after that knee-jerk and sharp reversal higher that came on Wednesday. Looking at an hourly chart of QQQ, we'll see where we could be headed in the near term. Treasuries, I will be talking about the short term, the 6-month treasuries and the 2-year. Last week we talked about it. Those are parameters of where we think interest rates are, not just immediately, but for the next few months. So we'll see what those two treasuries are telling us. We'll look at a big news last week. It was not so much of big news. It was an expected launch of the iPhone 17 has been extremely well received. Apple had a big move last week. We'll see what Apple's chart is telling us. How high can that climb continue? And then the crux of today's session is really about the melt up. Last week we talked about melt up. We know that this is massively AI-induced melt up. We've seen melt ups in Palantir, poster child of AI on the software side. Poster child of AI, of course, the king of AI is NVIDIA. That has had a massive move from below $90 all the way up to 184 in the last few weeks. We've seen melt up in Oracle. Just the fact that they didn't meet even their quarterly numbers, but the fact that they projected massive AI cloud revenue for the next 5 years till 2030 moved up the stock huge. So that was another classic example for melt up. Now, we will look at some different kind of melt up. Of course, there's also been melt up AI induced on nuclear stocks that have absolutely shot up. So in some ways, you could say the nuclear kind of is a stretched out commodity play, but it's a power energy play, and nuclear has kind of gone parabolic and melted up. But this melt up today is going to be about precious metals. We'll look at something that is repeating. We'll look at the parabolic melt up climb in gold and silver. We'll look at what happened last in such a melt up from a 3-year time frame from 2008 into 2011. That's pretty much repeating from 2022 bottom to the 2025 peak. We'll look at silver and gold. We'll look at their long-term charts, which their monthly charts will show how there is kind of a similar phenomena repeating from what happened in 2011 to what's happening now in the 2025. So with that, without further ado, let's go right into our blog site. It's called chartsarefun.substack.com. We appreciate you subscribing to it. As soon as the blogs are published, you'll be sent the blog via email. Our YouTube site is also Charts Are Fun. We absolutely believe charts are fun. A lot of great insights, helps you guide your trading decision. We don't provide investment advice. Our main goal here is to share insights on charts and show you how to read charts and take advantage of them for your trading decisions. Appreciate you liking the videos and also subscribing to our YouTube channel, Charts Are Fun. So I talked about treasuries. The big expected cut happened, as in market expected the 25 basis cut. We exactly got the 25 basis cut. But 6-month treasury kind of had, this is a weekly, every candle is a week. Didn't break down with knowing now that there's 2 additional cuts this year and another cut next year. In the 6-month time frame, we were perhaps going to get maybe 3 additional cuts. It didn't break down. If any, it only fell 2 basis points. From 3.86, it closed at 3.84. So this says market is not 100% sure that even though the Fed is indicating there's 2 cuts coming later this year and 1 cut into early 2026, as in 3 consecutive, this is a new cutting cycle started off in September. For the next 3 meetings, you can get additional 25 basis point cut. Market is thinking that perhaps you got to wait and what happens to the labor data. It's been very unpredictable. We know that there was 911,000 job revisions, but at the same time, economy is holding strong. GDP is doing quite well. It was, in fact, the previous quarter over 3%, and markets thinking that maybe the economy will hold up strong, labor market may not deteriorate as much as the Fed is thinking, and Fed may not have to do these three cuts. And we know that stock market is at an all-time high. There's a reason for Fed to be very cautious, knowing that they're going to stoke a continued bubble by just continuing to cut in such a strong, healthy economy. Also, the inflation is a bit of a concern. The tariffs have not fully been reflected into the prices. Perhaps we got to watch the CPI and see what it does over the next several prints that Fed's going to at the end make those decisions. So at the end, the 6-month Treasury did not drop as much as it could have if the market really believed those additional cuts are coming. It ended at 3.84. So where is that? It's between the neutral between 3.75 to 4%. The midpoint of that is around 3.84. So 3.87, but 3.84 is in that ballpark. So we are effectively looking at market expecting one additional cut in the next 6 months. So we got a cut. We from 4.25 we came to 4. So it's between the middle of the 4 at 4.25. It's about 4.12 to 3.84. Market's expecting another only one cut in the next 6 months. 2-year Treasury actually went higher. We had talked about this chart. We had said that we felt that this was a positive divergence as yields was coming to lower lows. The RSI was printing higher lows. So we felt that this could indicate a counter trend. While we would think that they could bear like the bond bulls or people who are expecting the interest rates to come down would have expected this yield to break down below 3.5. That has been a key support. Multiple times it got tested, and at that break from 3.5 would have measured all the way to 1.75. Why? Because 3.5 to 5.25, you're talking about 1.75. So 1.75 off 3.5 is exactly 1.75. So the folks who are kind of bullish on bonds, who expected treasuries to rally further and yields to tank down, would have expected that. And the 50 period moving average in blue is kind of bending down and preparing to break below. But remember, the 200 period, much longer term moving average in this case, is climbing. So when you have a 200 period that climbs and a 50 tries to cut below, that usually does not pan out. And until the 200 turns and starts curving lower, these bearish crosses don't mean much. And this may not even be a bearish cross. If we do get a rally here in 2-year yield and yield starts climbing, this may not do the bearish cross. It may just touch it and start climbing again. So that's something you to watch. This positive divergence in RSI, this positive divergence in MACD as it's retesting the key 3.5 level. It went below 3.5, 3.43 was the previous low around March of 2025. And in the recent low in September, 3.47. Yield actually went up. 2-year yield went up 2 basis points from 3.56 to 3.58. So market is not so much sure. So if you're talking about a 3.5 over the next 2 years, market thinks that perhaps the neutral rate of where Fed may stop cutting is not too far. So we are at 4, another 50 basis points of cut in the next 2 years, and that could be it, is what the market is thinking. So we got to look at what the fact that the 2-year yield didn't go down, it actually climbed higher, means market is not fully buying into Fed being as dovish as market thinks. That said, near term, market like the dovishness of Powell, the fact that he did give the 25 basis point cut and the fact that he did indicate that there would be 2 additional cuts coming is indicated in this hourly chart of the NASDAQ 100. If you look at the NASDAQ 100 ETF QQQ, this is a cup and handle. 583 is the left brim. The lower part of it is 558. Upper part is 583. So 558 to 583, you're talking about 25 points. At 25 to 583, you're talking about 608. That's where we think QQQ's hourly chart is indicating. We did get that knee-jerk pullback. We can see this is hourly in that inter-hour between 2 to 3 when the rate decision came. It pulled back and then immediately rallied back higher. And then coming into the following day, Thursday, gapped higher and has been continuously climbing. Yes, there is negative divergence with RSI printing a lower high as it's climbing. So you got to see what happens this week. But momentum is there. The melt-up phenomenon has been seen across many key stocks. This cup and handle, as I said, 558 to 583 is 25 points. At 25 to 583, 608. So we almost touched 600. on Friday. It was options expiration. There was an upward bias. Market QQQ closed up 0.68%, gained 4 points. So from 600 to 608, talking about 8 points. That can easily come this week, potentially what we're looking for. That said, this negative divergence, how far it has diverged from its 200 period moving average in red, indicates a pullback is at store, something we should look at. But near term, the bullishness in QQQ and what helped QQQ power higher was this big move in Apple. Look at how much Apple moved, 3%. Their phone got released. Tim Cook was in New York City. They showed the Apple Store on CNBC constantly. People out there buying phones like no tomorrow. So this was September 19th. And with the strong acceptance of the Apple 17, they have this new sleek design. The thin, very thin, skinny looking iPhone seems to be very popular. There are many that are due for an upgrade, and 16 didn't quite pan out from the Apple Intelligence, but now folks are focusing on the cameras, on the design of the sleekness of the phone, and 17 seems to be a hot commodity. People are buying it. And maybe people are also a bit worried about God knows what could happen to tariff. Why wait for it? Just go buy. And in fact, even though there was an increase in the iPhone Pro, the 17th Pro was price had increased from the 16th Pro, people are still buying it up. Consumer seems to be very strongly preferring the Apple's new upgrade. That said, there is negative divergence. It's like in QQQ, the daily chart of Apple shows negative divergence. But if you look at this ascending triangle breakout, what did Apple do over the months of the last 3-4 months? From that 168 low on April 7th, tested 215 a few times, and then broke out with higher lows. That's a classic ascending triangle. So 168 to 215, that's roughly, you're talking about $47 or so added to 215. 262, 263 is where we think this is headed. So 263 is Apple. It's right now 245. So easily another 17 bucks or so, it's possible that Apple could climb to get to that level. But this negative divergence with RSI at lower highs is a bit of a concern. We got to watch and look at the mega volume. This, of course, was options expiration. The bears weren't expecting Apple to climb as much. So then they had to scramble back and start covering and look at the big move with volume, huge volume in the Apple, and this move all the way from the 240s to the 245. So $7 move in Apple, and that adds momentum to QQQ. It's like, close to a $4 trillion stock, have got good momentum, and, it's helping power NASDAQ higher. Now, I talked about precious metals because I'm going to exactly explain why we are kind of repeating both in gold and silver, something that happened in the 2008 to the 2011 timeframe. Well, what happened in gold? From 680 to 1920, it was a factor of 3x is how it climbed, almost 3x. So this climb, when it happened, the parabolic climb, look at what happened in the factor 2022 to 2025, a 3-year climb again. And this time it almost didn't quite get to 3x, but definitely over 2x 1600 was the 2022 low to 3600. So that was a very big parabolic move. Look at how far it has diverged from the key period moving averages. Look at how far the MACD has climbed, extremely overbought. And look at RSI at 88. 2011 RSI didn't go as overbought at 88, but it had a deeply overbought RSI in 2011 as well. Well, look at now what the measured target from a weekly chart of gold, it could be headed in the near term. This is an ascending triangle. We tested a 3,500 in early April. From there, pulled back to 3120, went to 3460. That ascending triangle, after that breakout, measures to 3,800. We are at close to 3,700. We tested 3,707 this week, ended near 3,700 at 3,682. Talking about another $120 or so is what gold can climb and can get to the target. We feel that's coming. We feel that's where gold is headed. Now, if I look at comparison of the 2011 and the 2025, this is what happened in 2011. Look at from the early July, it had pulled back, and look at from the July to the early September when that peak came, look at how sharply it climbed. And then classic negative divergence, it printed two successive highs, 1911, 1920, with a lower high in RSI, lower high in MACD, and then it broke down, right? Look at what's happening now. We have that very kind of sharp climb that we got here is now happening in this time frame. That sharp climb is going on. RSI is at a lower high, so we may get to that 3,800 with a lower high in RSI. So that's the two successive peaks, 3,707 to 3,800, like we saw here, two successive peaks at 1911 to 1920. So those two peaks with a lower high in RSI, MACD histogram has already started curving, indicating that we are nearing a top on gold. That's where we think gold is headed. It is headed towards the 3,800. That negative divergence from an RSI at a lower high, MACD histogram gearing to break below the zero line, is indicating that gold is nearing a similar kind of a top like we saw in 2011. So that's something to watch. Now, what is a key indicator of a gold doing so well is gold miners. Gold miners, if you look at their pattern, it's a monthly chart, very big base, took very long time for the gold miners to react. So it has been pretty much rain bound from 11 to 43. It broke out of a 43 into 2025 and massive climb from near 33. It went up to 76 is the target. It is closed near 72. So more than doubled, 33. And every month except that slight pullback that we saw in the month of July, that was a very short pullback. Look at the 9 successive months of vertical climb. So from 33, it went up to 76. Look at how deeply overbought RSI is at 83. MACD, look at how far it has climbed, deeply overbought MACD. So gold miners, what is the measured target? Ascending triangle from the 11 to the 43, you're talking about 32 points, 32 and then the 33 cents to 71 cents. That's about what, 38 or so. So 70, 32.38 is what the difference is from the 43.71 to 11.33. So at that 32.38 to 43.71, you get a 76.09. So that's about $76 is where the gold miners potentially could be climbing. Now we're going to look at 2011. Look at what happened in 2011. It peaked out at about that late September timeframe. Two successive peaks, lower high in RSI. That's how tops form. So it's a double top, a classic double top, 58.93, 58.86, lower high in RSI, lower high in MACD, and then boom, a big breakdown in gold from 58, very sharply dropped. In a span of a couple of weeks, sharply dropped to 44. Are we setting up for something similar? I think we are. Look at how far it has diverged from its 200 period moving average. Look at where, the higher high is coming on GDX with a lower high in RSI. That's an indication of a topping pattern. And we potentially in the next week or so could be nearing that top, just like time frame, very similar end of September time frame is when GDX topped out, and then the breakdown. Expect a breakdown in the month of October. Even if you take a couple of weeks to get to 72 to 76, I would be very cautious on any additional upside. So this is setting up as a massively great trade for those that want to short gold miners. This kind of vertical climb on gold miners, reaching that 76 target, is a great place to buy an ETF called DUST. So you have DUST. DUST is how you play the bearish side of gold. And the gold miner itself, ETF, is GDX. And there is a GDXD and a GDXU. However, GDXD has come down a lot to $1. It's almost a penny stock. Not worth buying GDXD because those are penny stocks, are more riskier. But then if you're looking at Dust, it's around $12. That's a great place to buy Dust as GDX pulls down and gold pulls down. A great place to, and then if gold pulls down, the best way to play that is GLL, which is an ETF to play the downside in gold. So GDXD is a riskier one because it's become almost $1 or so. So they could perhaps do an inverse split, maybe a 10x and get that to $10. So that's a possibility. But right now, looking at Dust as a way to play, and then the GDXD and GLL to play the downside in gold. Now, Precious metals, I said, not just gold. Look at what happened in silver. Look at the vertical climb silver got back in 2009 to 2011, that 2-year time frame. Sorry, 2008 to 2011, 3-year time frame. Look at from where it went from $8 went to 49. Absolutely vertical melt up kind of climb in silver. Guess what's happening now? A melt up climb is coming. But well, how high is this time silver going to climb? We feel silver likely has some more upside, may not top out with gold. It may have a little more upside. Why? Because its long-term base is at about the 35 level. And then we can see higher lows in the last several years. And that ascending triangle from 11 to 34, you're talking about 22 cents. That 22 cents added to 34.86 gets us to 58.08. So $58 is where we think silver could climb. And we think that the potential possibility of why silver had additional upside is, let's look at the silver to the gold ratio, dollar silver ratio to dollar gold. Look at how high the ratio had climbed up to 0.03. It fell all the way to 0.007 in the 2020 COVID collapse. From there, the 2021 peak, it came up to 0.017, and now it is at 0.012. It's still got ways to climb. Just the fact that if it can reclaim the 2021 average, silver could be at 58 and gold could be at 34, 3,300, and that ratio could come at that 0.217, 0.218. So that's potentially where we think this ratio is now climbing. We believe there's more upside on the ratio to at least retest the 2021. So that is what the silver bulls are looking for. For the ratio to climb means silver outperforming gold. And as that ratio climb, it could help silver to achieve its ascending triangle breakout near 58. So that's got more upside. So silver, I would not short. I would stay away from shorting silver, let it have its climb and see how far it can go. If you look at its vertical nature of how well it climbed in the 2011, the other key pattern is in 2011, the peak in silver happened before gold. Peak in silver happened in the month of April, 49, and see how sharply it came down. Look at where the peak in gold happened in the 2020, 2011 timeframe for gold. So silver peaked in April, gold peaked in September. So it was 5 months later is when gold peaked. This time it could be gold peaking out now and silver may go a few more months and may peak out later this year into early next year. It might be just the opposite. Why? If this ratio has to climb, if silver has to get from 43 to 58, anything is possible in melt-ups. Things happen so fast. Short covering and melt-ups just are like meme kind of moves these days. You see in a lot of things. Look at Intel. That's a classic meme move. Government took a stake, 10% stake in August. Then NVIDIA announced a $5 billion investment this week. And boom, what happened to Intel? It shot up from near $25. It went almost to 32. Pull back and close near 30. But look at the sharpness of that move of silicon, semiconductor stock that has been struggling with its business. So meme action is happening everywhere. If silver gets a meme action, wouldn't be surprised for it to peak very quickly from 43 get to 58, but that's the target we're expecting to exceed the 2011 target at 49, just like gold exceeded the 2011 target, and we should see what happens there. So to sum it up, the rate cuts came, and guess what happened to treasuries? The 6-month treasury didn't drop much. It actually only dropped 2 basis points. It is giving 3.84, means in the 6-month time frame, treasury market is going to wait out and see what happens to inflation data, what happens to the jobs data, and not just price in the 3 additional cuts that the Fed signal. Fed signal 2 more cuts this year, 1 cut next year. So next 3 successive meetings are signaling for 3 cuts. That 3 cuts from a 4 to 4.25 would have brought this down to 3.25. We are not seeing it. We are seeing at 3.84. Means the 6-month treasury is expecting 1 additional cut in the next 6 months. 2-year flattened out and started climbing, a small climb of only 2 basis points, but basically it's at 3.58. So this is indicating a 3.5 in the 2-year time frame from where we are at the 4 to 4.25. So at this point, we are really talking about maybe in the 2-year time frame, the treasury thinks that maybe at the most we get something of the order of 2 cuts, right? Is what it expects the market to do. So 2 cuts is what it thinks in the 2-year time frame is what the Treasury thinks. QQQ, this hourly chart is in a melt-up mode, cup and handle move, more upside. Yes, there was a sharp drop after the Fed decision from 589 or 590, it fell to 584, retested that level of breakout level of 583.77 or 584. Smart money started buying, breakout. This move measures to 608. We could get there this week. That said, the RSI is showing lower highs, negative divergence, and we believe that we could then from there start getting a late September into October pullback in QQQ. So preparing for that pullback. Apple, great breakout from its great iPhone 17 sales on its first day on Friday. 263, its upside, even though it gets a pullback because of its negative divergence in RSI, could have momentum to take it towards 263. From 245 to 263, we are talking about $18. Apple could get there pretty quickly. The gold, as we said, is absolutely gone vertical. And if you look at the vertical nature from 2020 to 3-year vertical climb is identical to the 3-year vertical climb gold had from 2008 to 2011. So we're comparing this time frame to this time frame kind of a move. From there, that overbought, see how in a span of 2 years, how far and how quickly it dropped. We expect similar kind of drop in gold setting up. Look at how overbought MACD and RSI is at 88, almost 89. So if you look at what happened in gold in 2000 in the weekly time frame, that's the measured target. We are not too far from it. We tested 3,700, another $100. We'll get it to 3,800. That's where we think this ascending triangle measures to. So that's the upside in gold. And once we get to 3,800, we would back up the truck and start buying GLL because we are quite confident gold is going to see a downward move. And looking at the 2011 repeat, there were two successive tops with lower high in RSI. Negative divergence is how tops form. And look at from there how sharp it dropped from 1,900 to 1,500, a span of $400 break in gold in just a span of a couple of weeks is how sharply it fell. Parabolic climbs usually have sharp drops, and that's what we're worried about gold here as well. That's a very parabolic move. 3,800 will come with a lower high in RSI, negative divergence. MACD histogram is beginning to turn lower below the zero line, indicating a pullback is coming. And we are expecting a pullback from the 3,800 towards the 3,400. So $400 cutback again, very sharply is what we expect, which is a great way to play GLL, which is 2x short gold. And that could give us good upside in GLL when that happens. Gold miners to us, it's got an ascending triangle breakout. It's a multi-year breakout. That measure target is at 76. It's almost there at 72. $4 more and it'll get there. And to us, this breakout in many ways is a sharp move in a 3-year time frame like gold from 2022 to 25, from 20 to 76, a factor of 3.6x is how much this moved. Look at what happened, 13 to 58, right? So that's also, in fact, almost more than 4x it moved in that 2008 to 2011 3-year time frame. So that to us in the gold miners is repeating now. And to us, that means that if you look at the gold miners chart, its 2011 had 2 successive peaks. And after that, with negative divergence is what you watch for. Classic double top and from there a breakdown. We expect something similar happening this time, not a double top, but a higher high, but lower high in RSI. We expecting GDX to break down after it tests 76. A great way to play it is buying an ETF called Dust, which is bearish on gold and gold miners, and Dust could be the way to play it to play this downside. It's near $12. So if we expect the GDX to break down, Dust will start, if it breaks down 5%, Dust will go up 10%, twice X of that. And finally, the precious metal silver also has had very similar kind of move that happened in the 2008 to the 2011 timeframe. That vertical move is kind of playing out here. We do feel that its ascending triangle breakout has more upside. So this last time, silver topped out before gold. In 2011, silver topped out in April. Gold topped out in September. This time, the reverse may happen. Gold may top out in September. Silver may top out a few months later. Why? Because the upside on gold is 58. It's currently 43. So we would not short gold, short silver or silver miners. We think there's upside there in silver. playing up to 58, a melt up kind of a move. Next couple of months, we would watch as it shoots higher. And that said, the ratio is what's pointing us to the upside in silver. If you look at the long-term silver to the gold, this is not going to be retested, but at least a retest of the 2021 is possible. Right now, it's 0.012 towards the 0.017. Even if it has to retest at 0.017, you're talking about silver at 58 an ounce and gold coming down towards 34. If you do that ratio, it'll take us similar to that 2021 peak. Good luck investing. We'll talk to you next week. Thank you.